$893 plus the balance brought down in Joe account of $8,895 plus the balance brought down in Ben's account of $5,896. The three accounts added together must give $24,684, which is the balance brought down of the total receivable control account or the sales ledger control account. Of course, the total receivable control account has now summarized the transactions that took place in Ben's account, Joe account, and Ben account. And this is the purpose of preparing the total receivable control account. Now, before we progress into the total receivable control account, I would like you to take this assignment and practice it. Remember, without practice, you have little chances of improving. Assignment: prepare a total receivable control account from the data below. Opening balance $6,000. Sales $45,000. Bad debt written off $16. Cash received $26,000. Check received $1,200. Discount allowed $230. Interest charged on customers $900. Dishonored check $230. Note: all transactions are in dollars. You are welcome to the preparation of the total payables control account or the purchases ledger control account. Remember that when we purchase goods from suppliers without paying them, we call them trade payables. In preparing the total payable control account, we should note the following. Payables are liabilities and has credit balances. Therefore, in the preparation of the total payables control account, the opening balance, which is the balance brought down from the previous period, will be credited to this account. Then we credit alongside any transaction or every transaction that will increase the amount we are owing payables. On the other hand, we debit in this account all transactions that will reduce or decrease the amount we are owing payables. At the end of the period, the difference in the two sides of the account represents the closing balance of total payables account for the period. Note that the payables control account can also be called purchases ledger control account because it is when we purchase goods from suppliers without paying them that the word payables or trade payables comes into existence. Let's begin our entries with some imaginary figures. Assume that the total opening balance of payables for the period is $24,000. What we do is to credit this to the total payables control account because it represents the amount that we are owing them for the previous period, which now comes into the current accounting period. Now, the balance brought down is $24,000, and this represents the amount we are owing payables at the previous accounting period, which is now brought forward or brought down to the current accounting period. The next thing that will increase the amount we are owing total payables are purchases. When we purchase more goods on credit, it increases the amount we are owing. And this increases the total amount we are owing payables, and in line with the rules, every transaction that will increase the amount we are owing payables should be credited. So we credit purchases to this account, $75,000. The purchases in question represents credit purchases and not cash purchases. The total amount we are owing payables at this point is $24,000 plus $75,000. Another transaction that can increase the amount we are owing payables may be interest charged on suppliers. This interest may be charged for transactions such as interest on overdraft. And when there is interest on overdraft, it means that the fund borrowed from suppliers of capital has generated interest and has to be added to the amount we are owing them. Thus, it has to be credited. So we now credit interest charged by suppliers of $1,005 to the credit side of the total payable control account, now increasing the amount we are owing them. Let us look at some transactions that will decrease the amount we are owing payables and which, according to the rules, should be debited to the total payables control account. Let's look at cash paid to suppliers. When we purchase goods from suppliers on credit, what we do to settle this transaction is payment, not receipt. So, if you hear cash paid, check paid, bills payable, they all relate to a way of paying or settling suppliers. So, when there is cash paid, the amount we are owing payables will reduce and has to be debited to the payables control account. Also, when there is check paid, the amount we are owing payables will be reduced and has to be debited to the payables control account. If we have something like discount receipt or purchases discount, of course, it still has to be debited to this account since it reduces or decreases the amount we are owing total payables. If cash paid to suppliers or payables is $45,000, it reduces the amount we are owing them. Also, when check is paid to payables, it reduces the amount we are owing them. Here it is $12,000. When there is discount receipt, here it is $2,000. It also reduces the amount we are owing payables. Discount received is also known as purchases discount. And when we receive discount, what it means is that we are not going to pay a total of $75,000, but $75,000 less $2,000 discount. And that is why we are debiting it, because any amount we are debiting here, when we add the credit side and add the debit side, it is the credit side minus the debit side that gives the remaining balance. Thus, any record on the debit side of this account will reduce the amount we are owing payables. For the purpose of our operation on foundation level, we are going to limit our transactions to these three entries on the credit side: the opening balance, purchases, and interest charged by suppliers. We are also going to limit our entries on the debit side to cash paid, check paid, and discount receipt. By the time we progress into more comprehensive questions, we are going to bring other items and transactions that should be either credited or debited into consideration. For now, let us balance this account to find out the amount we are owing payables at the end of the period. How do we do that? We add up the total amount we are owing them directly or indirectly. That is $24,000 plus $75,000 plus $1,500. Then we deduct the amount that we paid them directly or indirectly. That is 44,000 plus 75,000 plus 1,500, it gives you $100,500. Now you close this account here. This represents the total amount we are owing payables. Now we now deduct the amount that we paid them directly or indirectly. That is 100,500 minus 45,000 minus 12,000 minus 2,000. That gives us 41,500. The balance carried down, which represents the closing balance we are owing payables, as 41,500. If you add 41,500 to 2,000 plus 12,000 plus 45,000, it gives us back 100,500, which is now closed in the same line with this. And finally, the balance carried down of 41,500 is now taken to the credit side and becomes the opening balance of the current period, that is balance brought down of 41,500. This now represents the net amount that we are still owing the payables or the total payables. It should be noted that each of these figures here represents the accumulated or summarized amount of all the payables. Just like we saw in the total receivables control account, the $45,000 we are seeing here is $45,000 paid to all the payables. They may be 10, 20 or more. The same, the check paid relates to the check paid to all the payables. Discount received from all the payables. Purchases from all the payables. Interest charged by all suppliers. So this is total payable control account, bringing to summary all the transaction in relation to payables. Just like we saw in the total receivables control account, individual ledgers were shown and summarized in a table. Here, it is the figures that have been summarized in the table that we are now using to prepare the total payable control account. We are going to limit our operation to this for the sake of your foundation knowledge as we progress into more comprehensive questions. For now, you take down the assignment. Assignment: prepare a total payable control account from the transactions below. Purchases, $75,000. Opening balance, $24,000. Cash paid to suppliers, $45,000. Check paid to suppliers, $12,000. Interest charged by suppliers, $1,500. Discount received, $2,000.